Hey guys, we're going to be going over the week of October 10th, 2014, just kind of doing a weekly recap here. So, what was important this week? The big item in my mind is the move in volatility on Friday. So, let me bring up a site here, VIX Central, and they've got, as you can see on here, the futures forward curve for volatility has moved into backwardation. What that means is the spot price for volatility is higher than a lot of the other parts of the curve. So basically, the way this works is like on Friday, all contracts for all of these months were trading, and this is the closing prices for each of these months. And if we go backwards a day, you'll see that it had only just started to move into backwardation on Thursday. So let me go to historical prices, and we're going to look at October 2014. It's going to be the 9th. Get prices. So it had just started to move into backwardation at the front of the curve, the October contract. The November one still priced below the December. So let's go back one. There we go. And as you can see, Wednesday, October 8th, we had a normal volatility curve. So basically what I'm reading from this is there was a lot of buying coming in to volatility. So it's big money looking to hedge their portfolios because they don't want to sell all their shares for tax purposes. So what they can do is they can either short stuff to offset their longs, or they can buy volatility. So buying volatility is very much like buying puts. It can give you a similar hedging effect. So we did a study this weekend on the relative size of the move in VXX versus SPY, because it was a huge move in VXX on Friday, and not so much in SPY. So if we look at VXX, let's go to online details here. So Yahoo is showing an 11% gain on Friday for VXX, and if we look at the S&P 500 itself, it only lost 1.15%. So this made me think, hey, something weird is going on here. The move in volatility far outpaced what we normally see for a down move in the S&P 500 of this magnitude. And so that's why I went out to look at VIX Central and look at the futures forward curve, and spotted this backwardation. So why this isn't being talked about more in the news, I don't know. But for me, this is big news. So anyway, back to the study I was trying to tell you guys about. Let me bring up a picture. So what we have here is we filtered out all the days where the S&P 500 did not move more than 1%. And when it moved more than 1%, we took the price move in VXX and divided it by the price move in SPY. And these are percentages we're working with. And so what we found is that the move on Friday, right here, was 9.9, and this is not like Richter scale or anything. This is, but it's this is a huge move. This is the biggest move that we've seen on a relative basis. So VXX relative to SPY, biggest move we've seen since the inception of the VXX ETF, or ETN rather, exchange traded note. So this is big news. What does it mean? backwardation. Let me bring up the futures forward curve picture here. And with backwardation, what that means is that the market is, they want their volatility protection right now. They're bidding this up. They're willing to pay more for it now than in the future. And normally, here, let's look at the normal curve. And normally, we see this with commodities too. It's like you would pay more to protect for a longer duration, right? Or you would pay more to have your commodity delivered to you at a later date, because you're basically paying the market to store it for you. And it's similar with volatility. It's like, why would it cost you more to have protection now than it would for like 180 days out? Like it's costing you on Friday, it would cost you less to buy protection 180 days out than it would be to buy protection for like October. And options expiration, by the way, guys, options expiration this month is not the 24th, it's the 17th. So, that spot is going up like this when we've got like next week to go. It's kind of an omen to me. So are we looking at like a Black Monday or like, or maybe like a Black Week? I don't know. But I expect lots of turmoil next week. And it's not just the October contract going up. We're seeing the November contract also going up too. So
now, what if you flip this on its head and say that this is the result of a rocky market right now, and that these are folks fleeing to safety or trying to buy insurance for the current market conditions?
Yeah, that's a really great question. What I want to look at and speak to that is the flash crash of 2010. So let's go over to 2010, and we're going to go to May. And what you'll find is like before the flash crash was not preceded by an inversion of the VIX curve. So here's May 5th, and it's again like a pretty normal curve. The next day, here's the flash crash. Here's what volatility curve looked like on the day of the flash crash. And like these are close prices or settlement for that day. So they don't really reflect the intraday action, which was just completely nuts on that day. I can only imagine how ridiculous this looked. But if we look the next day, everyone was buying protection on May 7th for who knew what was going to come. But anyway, like this is what it looked like, just this massive inversion. You got a pretty flat curve, and if you notice the curve is much higher, it's in the 30s than where it is today. So let me back up a few days so you can see that like the curve is like even 2 days prior, or I'm sorry, 1 day prior, May 5th, the curve is in the mid 20s. And if we go back, you could probably see that it was rising going into it. We did a comparison study this week. I can bring that picture up in a minute, but
a question about the actual numbers here, the values of the volatility index here. Are they significant across all periods of time, or do these slowly decay, and are smaller numbers more relevant in recent times versus larger numbers in the past? You understand what I'm saying?
Yeah. So this is it's a percentage number basically, and what it means is it has to do with like how likely outlier moves are going to happen as the market is pricing it across the entire options curve. So it does basically mean the same thing across all time. However, there are different ways of calculating the VIX, and so they're going to give you different numbers. And so the original VIX, I think it's You can still see it. It's like a VXO or something. Like we'll go over to stock charts real quick, and if we do like a $ VXO, you could see that. Here, let me zoom this out, and I'm going to show you a ratio chart of these, just so you could see the differences. But basically, like VXO uses less of the options than the new VIX calculation.
So the old way is still alive and well, but
yeah, it's still used.
But folks have shifted generally away from.
Right. So the new VIX calculation is see this up here in the heading. It's like original formula VXO, and then new methodology VIX. The reason VXO is even still a thing, it uses less options or fewer options in the calculation, but the data goes back on it like through the 1987 crash, if I remember right. So that's a reason why people consider it to have legitimacy, is because there's data through that very meaningful period.
And on this ratio chart here, I mean, it's pretty much horizontal.
Right. They're basically telling you the same thing.
But yeah, it's just on any given day, there's going to be a fluctuation.
Right.
But the long-term trend, it holds up.
So, so back to the backwardation real quick on VIX. This doesn't happen very often. It's we see it happen on May 7th in 2010, and that's again after the flash crash. And the market did go a little lower. We put out a study this week on the market heading into the May 2010 flash crash compared to the market today, and looking at about an 8-month window, and that's something I want to look at. Let's see here. Another time where the yield curve inverted was 2011. If we look at August 4th. So like I went through all these yesterday, or maybe it was the day before, and this is where the spot price is basically above the entire curve, and that doesn't happen very often. So you can see like it made a big move in one day, August 3rd, and there it is. Now the spot is above basically the entire curve, and we're not quite above the entire curve today. Let me go back to today, and you could see that like it's not quite above the entire curve, but I mean this could change dramatically in a day. So anyway, it's a very rare thing. It's like in 2008 for that crash, the VIX futures forward curve went into backwardation, and that's like a big theme of this site when you come in. Or I'm sorry, when I went to historical prices, when we first get here, they want to show this to you that like, look at this crazy curve inversion here on October 16th, 2008. That's just kind of a neat thing that they're highlighting. Anyway, this is such a rare condition, and what it means is that if you are carrying crash insurance and the curve is inverted like this, you're making so much money every time you roll a contract if it stays like this. But this is an unstable configuration for the curve, and when it breaks down, you could quickly lose money if you're trying to carry this insurance. But you can, as long as it stays inverted like this. And we see oil sometimes will have an inverted or a backwardation futures forward curve for quite some time. Anyway, let's just quickly look at the 2010 flash crash. Look at that study that we put out this week. Looking for SPY. There we go. Okay. And I'm going to change our dates to be going into the flash crash. I'm going to look at, I think, September 2009. Just go September 1st. And let's go right up to the flash crash. Okay, so this does not include May 6th, and you can see that over here in the report. It tells you we're going from September 1st, 2009 to May 5th, 2010. And this kind of frothiness in the market up here in the upper right corner of the screen, like this is particularly interesting right now because if I clear these dates off and we look at, I don't know, like the most recent 8 months right now, let's go back to, I guess, like we'll say February or maybe March and look, you'll see a similar frothiness right here in the current market. So, I mean, these very tall bars, it doesn't happen like this very often. Um, so anyway, it was worth noting. So anyway, moving on. Some other things that we looked at was let's flip workbooks here. I want to go to the spider sectors. I'm going to sort these by performance. And actually, I want to do a year to date. So let me zoom this out to January 1st. So here's a year to date performance. We're going to sort these sectors. So here's utilities at the top, and here is energy now at the bottom. And I think earlier in the week it was XLY at the bottom. And XLY is consumer discretionary. So that's really interesting. But anyway, now it's energy, and we've highlighted quite a bit of stuff on energy recently. So one of the things that we've looked at is so by the way, energy is negative for the year, and the utilities are up 16% for the year. So really interesting. Anyway, one of the things we looked at, if I remember right, flip over to just kind of a workbook where we can look at anything we want. I'm going to make a new portfolio here, and I'm going to, I don't need to do that. Put S&P 500 in there, and I'm going to put XLE, energy ETF, in there. And let's get like a comparison of these. So you can see that energy was outperforming earlier in the year, and it has just dropped into a precipitous decline. And if we look at the oil price, you'll see it there too. So it's loading right now. And you can see oil has really gone down a lot this year. Another study that we put out is we took a look at the XLE holdings. And what we did was we sorted the XLE holdings by performance. And there we go. ExxonMobil is all the way at the bottom. This is year-to-date performance. It's minus 7%. And Chevron is second worst performance in the XLE of the top 10 holdings at minus 6%. And interestingly, if we go out to XLE and look at the weightings, I'm sorry. I'm going to look at Yahoo Finance, the weightings here. You'll see that like ExxonMobil is 15% of the ETF, and the second biggest holding is Chevron, at 13%. So, the biggest one has sold off the most, and the second biggest one has sold off the second most. And combined, it's 28% of the ETF, or over a quarter of it. So, and they rapidly drop off in weighting here. So there's a whole bunch of other little holdings that are not shown, but it's just kind of interesting that the biggest ones are selling off the hardest, and that's not a typical behavior that I would expect, especially given that we're seeing the opposite behavior. This is another big theme this week. We're seeing the opposite behavior when we price the small caps in terms of the big caps. So we've got a ratio chart up now, IWM to SPY, and it is just tanking right now, and has been for a while this year. Well, I mean, the whole year basically. And I'll zoom out and show you a bigger view in a second, but basically what's going on here is the small caps are underperforming the big caps by a wide margin, but that's not what we're seeing in energy. We're seeing the opposite. The big caps are underperforming the smaller ones. So I can't really explain that yet, other than maybe it has to do with international trade and oil, and maybe it's sanctions, or some kind of geopolitical risk is coming into the picture that might affect the bigger oil companies than more so than the small ones. So let's zoom out on this a little bit just to give some historical perspective. So you can see that we're at 0.55 here on the IWM/SPY ratio chart, and it's kind of at the low end of this range that it's been in for 10 years. And if you go further back, it's the small caps have outperformed for even longer than what you could see here. But that trend is kind of stalled out, and we are seeing a thinning of market breadth, which are we at the end of that? I don't know, but it's kind of a weakness in the marketplace right now.
What's been going on within the Russell? Back to your theme of
yeah, we were going to build a new workbook for that. Let's see here, Russell components, I guess.
Yeah.
Okay.
It's kind of a crude assembly here of components, but it does allow us to build a bit of a spectrum.
All right.
So the largest is going to be the top 50 mega cap.
Okay.
XLG.
XLG. Let me clear off these dates.
So this is the Russell 50, if you will, top 50.
I've got SPY in my denominator.
Okay.
Oops, cleared that out. Okay.
And then we have IWL, which is the Russell Top 200. So it's got the 50, but then it's 150 smaller cap companies.
Okay.
The third one is IWF, which is the iShares Russell 1000 ETF.
Okay. So this would contain these bigger ones.
Yep.
Okay. All right.
And then we have the mid cap IWR, which is the iShares Russell Mid Cap ETF.
Okay.
And then at the bottom we have RSCO, which is a Russell Small Cap Completeness ETF.
Okay. And it looks like the flash crash really did a number on these, on the data. It's kind of interesting. Mm-hmm. I'm just going to quickly click through these and just watch for the flash crash bar here. So it looks like this one was the least affected by it. Maybe this big one too, XLG. The two biggest ones are least affected.
Yep.
Okay, so let's do a sort. And we want to do, I guess I'll just do total return. Let's pick a date range. Should we just look at for this year, 2014?
Yeah, this year.
like year to date?
The real interesting stuff I think happened September 1st on forward.
Okay, let me resort. I'm going to sort by total return, descending.
Because you can see that rollover there on the far right
So
hand.
here's the best one, XLG. And this is like extra large, right? Is that the deal here? Guggenheim Russell Top 50 Mega Cap ETF.
Yeah.
Wow, that's interesting. And at the all the way at the bottom, RSCO is the Russell Small Cap. So we could actually look at an interesting spread trade here. So here's what you'd look like year to date if you were a genius and you went long the extra large caps and you shorted the Russell Small Caps. You have an 8%, 8.72% return for the year. What's IWL? Was that the second largest one?
Yeah, that's the top 200.
Yeah. All right. So let me clear off this portfolio, and I'm going to throw all these into one and see if we can get a graph that shows them all. So here we go. You can see the Russell Small Cap doing very much underperforming the other ones.
Yeah, if you zoom in a little more on the most recent history, you can see the differences a little better.
Okay. Should I look at like from May maybe, or
I do it from like
June?
July.
July?
Yeah.
Okay, July 1st.
There you go.
There we go.
Now you can see it.
Okay. And let's step back and get some historical perspective here on how correlated these things are. I mean, I expect them to be very correlated, but just flip over here and look real quick.
Oh, yeah.
Yeah. They're like all 99% correlated.
Yeah.
That's hilarious.
But they definitely move differently with more risk as you move down the market cap spectrum.
Yeah. Okay, one other theme that we were looking at this week is I haven't seen much about this yet, but I noticed a breakout in when I did a ratio chart. I was comparing China and Russia. Here we go. So I'm going to put Russia in the denominator and look at the China ETF. So you can see when I have them both visible here how similarly they move, and you can see this kind of divergence here at the end. And they don't always move in lockstep, but historically the correlation is pretty high, 80%. And when we look at this chart, you can see that it is turning upward again, and there's a little bit of volatility to it. But in the market crash of 2008, you could see that China outperformed Russia for basically the entire down move. And I'm wondering if a similar thing is starting to happen. So let's zoom in a little bit, and you could see that there's kind of a ceiling here, and now it broke out above that ceiling, and it's now kind of off making a new high. So that's kind of an interesting theme. Oh, another theme we looked at was some social media stocks. Twitter was moving really big this week, and so I wanted to look at what were these social media stocks doing relative to each other over the period since the Twitter IPO, because Twitter is the most recent of these publicly traded shares. So on 11/7/2013, November 7th, is when Twitter started trading, and so that's when our graph begins. And you can see that the red line here is, oh, I've still got RSX on the chart. There we go, cleared it off. Okay. Facebook outperformed, and it's also got some price stability that the other ones don't have. So Twitter had some early volatility in late 2013, where it had a nice big rise, but then it fell, and it kind of along with LinkedIn, they both kind of fell, and they bounced around a little bit, but much more volatile, and they are smaller market cap than Facebook by a lot. Let's look at Facebook first. The Facebook market cap is like 25 or 30 billion or something.
Yeah. I got it right here. Facebook's 189 billion.
Okay, I was thinking of Twitter.
There.
Okay, yeah. So Facebook 189 billion, and if we look at Twitter,
Twitter comes in at 30.58.
Okay, so that's the one I was thinking of.
Yeah.
So much smaller and very volatile right now. Minus almost 9% loss on Friday, and then LinkedIn.
It's at 24. Yeah.
Okay, so
less volatile.
On Friday,
On Friday.
yeah. But overall, much more volatile than Facebook. So Facebook is kind of the stalwart right now in the group, and Facebook's kind of the stalwart in the group, and it's the big cap outperforming the small caps again, and we're seeing that theme again. All right, so thanks for watching, guys, and we're going to be putting out more commentaries like this, so if you enjoyed it, please subscribe to the channel and thumbs up the video, and you can retweet our tweets. We appreciate that. Thanks.